Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome once again, Art Jarvis, to episode number 12, Taking Stock.
Yeah, fantastic to be here, as always.
You know, there's a tone in that. But it's a treat, so we're going to have some fun with it today, right? Talking about what's happened. I mean,
we always do.
Yeah, you know, as always, we talk a little bit before the on-air light goes on and we begin the episode for real. You said it's been crazy, let's say, at least for the last 3 weeks, maybe even the whole last month.
Mm-hmm. Very much so. And you know, I am human, and there are days where I go, why am I in this business? And, you know, there's days where you feel like a genius, and there's a day where you just feel like a monkey. So, you know, but...
How are you today, monkey or genius?
I'm somewhere in between, probably. You know, okay. I don't hit genius level too often, but I'm not feeling like a monkey today. Let's put it that way.
So I can't call you professor today. You're not on a genius.
Yeah, that would... Yeah, you can call me whatever you want. But, it has been crazy. I mean, since, we were in the middle of it 2 weeks ago. You know, today's Election Day, November 7th.
As we sit and record this.
Yeah. But
the people won't hear this until the day after Election Day. But as we sit and record this episode, it is Election Day, November 7th, 2023.
Yeah,
where are we?
It'll be Thanksgiving before we know it. But where are we? In the last, really since the end of July, we had a really good run in the middle of the summer, and then we kind of started working our way down. But starting about 4 weeks ago, we really started taking some big hits to the tune of 8 to 10%, where the market dropped, and theoretically, like if you look at the NASDAQ and the S&P, we were in correction territory. So that's how much it switched. But so 4 weeks or 3 of the last 4 weeks, the market was getting beat up pretty good. And again, it was mostly associated with what the Fed was talking about. The crazy thing is then last week we almost get it all back. So we dropped down to 4,100 on the S&P 500, and then last week we jump up like 6% or so, and it was 5 days in a row, and we've had some good days this week too. But it's 5 days in a row where we were up like almost 1% or over 1% a day, and it's like where's this coming from? And rightfully so. If I was talking to clients, it was, we are in the land of ridiculousness. That's how far down we had dropped. There was no reason.
Well, and for point of reference, so like you say, got down to 4,100. It was at 4,400.
Right.
S&P, NASDAQ.
That's right.
But and then last week it spent the whole week, recovering.
Yeah. Yeah, at this very moment, we're back up to 43.75. So we've
all back.
Basically, it's all back, right? So
minus 25 points, but they'll be back before the week is out.
Well, we'll see.
I don't know. You know what? And we'll see is exactly right, because it is Election Day as we speak. And so a question I want to ask you, that I wanted to ask you, and I will ask you eventually if I shut up and ask it. It's Election Day.
Yes.
So what's the usual impact? This is not a presidential election year. Mm-hmm. We're headed to one, but it's not a presidential election year, 2023. What's the usual impact election?
I mean, it depends what's on the ballot, right? I mean, if we're looking at local, we're looking at school board, and, Ohio has a few issues and a couple of tax increases or tax renewals. So I would say, in an election like we have today in Ohio, the impact market-wise is nil. It doesn't have it really. There's nothing other than, tomorrow we might have some very unhappy people, and that provides a little bit of negativity that's really not associated with the market, but maybe carries over. But no, there's nothing. The big stuff's coming up. I mean, we're going to have some primaries, and we're going to pick at least a couple people who are going to run for president, and that's when it really ramps up. You start to get all this rhetoric. You start to get all these promises and all these great things that they're going to do for us, and historically, typically, an election year is a good year in the markets. So, yeah, I mean, that would be the impact, and, I don't see any, at this moment in time, I don't see any reason for, the rest of 2023 and heading into 2024 to be any different.
And the purpose for that question, and that's good clarity in terms of how an election day impacts the marketplace. And that was the purpose for the question, because I just said, we're going to spend the rest of this week regaining those last 25 points, unless there's something that's going to impact it, in that negative zone. This election day, with none of those kinds of issues on the ballots, not going to have that kind of impact on the market. Practically nil, as you said.
Yeah, very nil. I mean, it's not even on my radar screen. The happiest thing about today for an election is that all the election signs come down tonight.
Can't wait.
They're worse than orange barrels, but
you know what? Here's the next question on that. We're kind of getting off, but the marketplace. So, I guess the sign makers are going to do well, because now it's a presidential election year.
right.
But that aside, it's like, how long? Pretty much the signs do come down in a day. There's some strays, stragglers that don't get right on it because they lost, or their issue went down to defeat, or whatever the case may be. But how long will it be before we see the doggone next set of signs? I mean, it is worse than orange barrels, because the orange barrels never really seem to go away either.
No, that's right. They just move them down the road and then start over again. But no, yeah, you're right. I mean, and it's interesting to me, and not that this has anything to do with the investments or stuff, that the use of signs in the last decade or two has just skyrocketed. I mean, if you pull up to the corner of a couple of intersections that you and I are familiar with, I mean, you literally can't even see around the signs to see if there's a car coming, so you have to be extra careful. So
that wouldn't be the bottom of Branch Hill, Guinea, and Loveland, Madera Road.
Yeah, well, Loveland, but I was thinking Loveland, Madera, and Lebanon, but same thing, right. Exact same thing.
Yeah, but, that one, and let's see, Ward's Corner.
Yeah, right. Well, and again, and it's bigger signs too, right? The signs are getting bigger.
Well, that's what's amazing. That's what is amazing. Well, anyway, hey, this is taking stock. We're just taking stock of what's happening around us, and it's election day. Mm-hmm. And when people hear this, like I said, it's going to be the day after. But for the record, Art Jarvis cast his vote already. Yes,
I did. And so, first thing this morning.
And so did Chuck Gibson and his family.
Yeah, it's my responsibility to do so.
We filled in the little circles on the ballot.
That's right. Well, mine were rectangles.
Is that right?
Yeah.
Wow.
Is that right? Were yours really circles?
They were like egg-shaped, yeah.
Ah, I'll be darned. Mine were rectangles.
I'll be darned.
Yeah.
Different kind of ballot.
There you go.
Sims Township.
Yeah.
Yeah.
Yeah, Ward C.
Well, Miami Township.
Yeah. I guess they prefer.
Sims Township, Loveland. Miami Township, Loveland.
Yeah.
We're both Loveland.
Yeah, that's true.
Talking to our favorite Loveland listeners out there who, are taking stock along with us.
That's right. And wondering where we're going with this.
We're going back to the roller. I wasn't sure if I should say it, but it has been a roller coaster ride. You call it crazy, you call it whatever you want, but it's been a roller coaster ride. At the end of the day, the roller coaster's got its, it's got its valleys and it's got its peaks, but you're going to end up on that solid platform at the end of the ride. Yes. Yeah,
definitely. We talk fear and greed. Talk about fear and greed all the time, right? So you work your way, you get down into the trough, and that's pretty much where people capitulate. Start to just throw the baby out with the bathwater and sell everything they have, and that's your trough. That people are like, I've had enough, and I've heard it here recently. I'm done with this. I'm not doing this anymore. But what we forget is there was a peak, and we went from like March or April of 2009 to the beginning of 2020, where we were just basically with a couple speed bumps we were rocking and rolling. We were doing double-digit returns in the U.S. stock market. And our portfolios should or do reflect those returns from that 10 or 11, 12 years, right? And so here we are in really 2020. You've had some rough times, and we're getting what's the word? Exasperated, I guess is the word. But we got to remember our portfolios are where they are because of all those good times we had while we were heading up to the peak. Now we're down in the valley again, hopefully getting ready to start another climb up. And we're still way ahead of what I would consider normal over if you look at it from a much longer time period.
Well, share that story because I think it's a good story. You can do it without identifying anybody. But you said you've just been there with a client who, as we dove into a valley 2 weeks ago, you got that phone call. Yeah. How does that go? What's that like? Tell if you don't mind sharing that story.
Yeah, and the thing is, these are clients I've had for 10 to 20 to 25 years, right? So, and kind of like I just said to you, we've had some really good times. We're just in some bad place right now, but the conversation kind of goes, I've had enough, I want out. That's kind of how it starts, or I get a text message, call me, I'm getting out, and right. and it's a very small number of people who do that, but it's a process on the phone where we talk about the economic numbers and we talk about history and things like that. We do some comparisons. How does what things are going on today compare to like the Great Recession of 2008? Why compare and contrast? We're nowhere near anything like we were in 2008. So you have this conversation and you talk about this is why. But the hardest thing, and I say this to people all the time, if you get out, again, we've talked about when you're investing in the market, you're investing 6, 12 months on what you think is going to be happening 6, 12 months forward. It's extremely hard to get back into the market because when you should be getting into the market, everything still doesn't feel good. You're trying to invest on where the better times are going forward. So, it's like, well, if you want me to get out today because of this, what's going to be the reasoning for us to get back in? Well, either we're going to get back in sometimes where it doesn't feel like we should get back in, or we're going to miss a whole boatload of returns. And, there's been studies where, if you miss 14 of the top 220 trading days in a year, you miss the vast majority of the returns that year. So that's kind of how the conversation goes with a person.
Wow.
In the end, and just to be honest with you, the conversation then goes, well, I still want out. And say, well, okay, but if you get out, we'll no longer be working together. Because why would you pay me to run your portfolio if you're not listening to what I'm saying to you?
Well, I was going to say, I'm glad you said that last part because it kind of sounds harsh when you say to a client, you know what, if you get out, then we won't work together anymore. And it sounds almost threatening, but what the truth is like, hey, I'm taking care of the client when I say to him, well, we won't be working together because, again, why would you pay me if, you're not going to listen, end of story.
Yeah, and you said it. For me, it is about, it's all a whole bunch of numbers, and it's always about money and everything, right? But for me, it's about taking care of people. And every single decision I make, I am trying to make the best decision I think for you. I'm not always going to be right, okay? But I'm gonna have a reason for what I'm doing, and it's going to be more of a global reason, but it's also going to be more of a person-specific reason. Mm-hmm. And if you're not listening to that, there's again, why would I take money for somebody where I'm not doing anything? I just don't. I'm not going to do that. Right. The other problem is then let's say I have 200 portfolios that are all the arrows are pointing this direction. And then I've got one, maybe two, where the arrows are pointing a whole other direction. It messes things up. It messes up the process, to be honest with you. Because then I'm trying to concentrate on 99% of the portfolios are heading this direction, and then I got this one over here that just is messing with me. And, so.
Well, there's interesting analogies to be made with what you're sharing about the numbers and what happens, and a client who's, I said to you before, you had to talk them off the ledge.
Right.
There's all those analogies, and we were talking about numbers and what they mean to you. And I mean, this is your passion. This is what you love, and I don't. but that's okay. That's why we pay somebody like you to take care of the numbers part. But I said to you then, well, at the same time, the numbers tell a story. That's my business. Mm-hmm. I'm in the business of telling stories. It's what I love. That's my passion, is getting the story out. I use words, but numbers, paint a picture. Numbers tell a story, and that's what you enjoy. And it's like, and then caregivers, because you talked about, I'm trying to take care of my clients.
Sure.
So it's like, tell me about how numbers tell a story for the listeners here. Mm-hmm. I mean, I don't know if you can give an example. This, I put you on the spot with this one. We didn't discuss this at all prior to talking. But I mean, how would you say that numbers tell a story? Just to give you a nudge, it's like, You've talked about it a lot, mm-hmm. and that is, because you're trying to project out the 6 months or 12 months. So you're looking at what's happening, and you're looking at what's happened. So there's a beginning of a story.
I think let me attack it this way. I think there's two ways to look at this. From an economic standpoint, from trying to make a global and a sector asset management decision for people, it depends on your time frame. Like, if I look at every single number every single month and I react to what it did in 1 month, I'm getting pulled in different directions, right? If I look at numbers from a long-term perspective and look at the long-term trends and things like that, I'm able to smooth things out a little bit and make a longer-term decision. I always say a couple things. One, the economy is a great big huge super tanker out in the middle of the ocean, and it takes a very long time for that to change directions, right? So now it might move a little bit this way, might move a little bit that way, and but generally it's kind of going in a direction. Now you start to see that change in direction, and it doesn't happen, with the exception of March of 2020. It doesn't happen overnight. They turned off the switch that March, and that's a completely different story. But normally, it's a slow process. You're not out there on a jet ski doing 180s, right? It's a long process. So I use numbers to tell a story, and that story is a long story. It's a novel. It's not a short story, right? So there's that. So that's kind of the big global way of looking at it. But then if I'm talking with people, I mean, we're all guilty. I'm guilty. You look at things in a certain way, and in a certain way that you look at things. And you sit here and you go, in the last, in 2022, last year, we lost 20%. Nobody likes to lose 20%, right? But again, it doesn't change what we're trying to do. We can tweak things a little bit. It doesn't change, but it's you got to remember that okay, we lost 20%, but we also made 12% per year for over a decade, from like 2009 to 2020. So I say to people that if you were more conservative, or you get more conservative, right now you have twice the amount of money or assets that you'd have if compared to if you actually had been more conservative and done things a different way. So it keeps going back to using the numbers to keep reinforcing, stick with the plan. That answer your question?
It does. The only additional, sure it does. I mean, that's the storytelling of numbers. Right. And that was what the question was. The next one is, if these last 3 weeks are telling you a story, and again, I especially appreciate you can't focus on these last 3 weeks. Right. You have to look at a longer history and a speculated longer forward view of what all this means. But if you said, what's the story we were just told? And the last 3 weeks is too short a period of time. Okay. But what's the story we've been told through the market, through the economy, the last 6 months? If that's if that's how you look, or what is the time frame you would look at right now if somebody said, hey, let's make a plan now. Sure. New client, let's make a plan now. Brand new client. So he can't stick to the plan, doesn't have one. Brand new client. And what are you looking back at to help project forward a good plan for a new client?
Yeah, that's a great question because it's really kind of interesting. If we were looking at last year, so we're looking again from more of a global standpoint.
Right.
Last year we're talking about we're going to run into a recession and everything's going to be terrible and all that. And it was interesting that we ran into 2023 and all of a sudden people kind of changed their focus, and it's like, you've been beating the drum for 18 months that things aren't as, the markets are not as bad as the rhetoric is trying to say it is. And people kind of started to come to that realization, and we ended up having a fairly decent first half of 2023. So you got that. So that's been kind of a change where some of that doom and gloom dissipated. It's still there, especially about once a month every time the Fed talks. But so you have that. But then from a portfolio management standpoint, and I always say to people, the silver lining to what we've gone through in the last, let's just call it 2 years, is we have interest rates that were basically at about 0.5%. Now we have interest rates at 5.5%. If I get a new client, and depending on their time frames, their liquidity needs, their risk tolerances, and all those things, we actually have, in my opinion, more tools that we can use for that portfolio because, from 2009 to 2020, it was a U.S. equity stock-driven market. The international stocks were way behind, bonds were way behind. Nothing. It was all U.S. stocks.
It wasn't the money markets.
It definitely wasn't the money markets at 0.5% or whatever it was. So, but you now have the ability to say, I'm trying to achieve a certain amount of return in a portfolio with the goal of whatever that retirement or whatever that goal is going forward. But instead of, I can be in stocks making 10%, 9% per year, 10% per year, or I can be in bonds making 0.5%. Now I can be in stocks where I believe I'm making on average 9% per year. But now I can also be in bonds. Even if I'm in a conservative money market fund, I could be making 5.25%. Well, that 5.25% is a much better alternative than 0.5%.
Oh, by far.
So we can get to where we were trying to go to, but not only that, we can do it with less volatility, theoretically. Right.
And that sounds like, another question that's been in the back of my mind today specifically is for somebody who is, has a little bit of, we'll just say a little bit of cash, savings, whatever, that they want to start earning, especially with, the fact that, what do you want to call it? The money market has adjusted because of the higher interest rates.
Right.
What are the things that you point somebody that wants to take some money, keep it liquid, not 100% liquid, maybe short-term bonds or something like that? What are the things that are available to people now when you talk about those? You have additional tools because of the way the market is, getting a return on the dollar at 5.25 instead of 0.25%.
Right.
What are some of the things somebody should do with a smaller sum of money to just make sure?
Yeah, also a good question because a lot of people have stockpiled what we would consider very large sums of money in checking and savings accounts because they're scared, right? Well, if we're going to look at someone who is on this end of the risk curve and they're extremely conservative, at a minimum, take it and put it into a money market fund that's making 5.25%, 5.5%. That's a money market fund is what's called a stable value fund. So, and theoretically, again, I always say theoretically, sorry, but those have not what they call broke the buck, or they don't break the buck. It's $1 per share, and should stay unless something really bad happens in the world, it should stay at $1 a share. So you don't end up losing money, and right now you make that 5.25% per year. You can start moving up the risk curve. Like in some clients' portfolios, started putting 3-month, 6-month, 9-month, 1-year Treasury bills in their portfolio. Well, you're at 5.4, 5% up to 5.56%. So now you're getting a little bit extra. Then you can start heading into corporate bonds. You can start moving into agencies. Each step up, you're assuming a little bit more risk, and you should be compensated for your risk. So you can start. You get into two things: one, a little more risk, but also a little further along the risk. So instead of being from 0 to 1 year, if let's say you go to 1 to 3 year or 3 to 5 years, something like that, you should be compensated. So, but it's still, from a risk standpoint, you're still taking much less risk than you would be just in the stock market, with, again, relatively decent returns now.
Sounds like it. What are the drawbacks, to doing that, if any? What would you caution somebody against if they're saying, "Hey, this is what I want to do"? What would be the cautions?
I mean, the nice thing about a money market fund or something, you don't have penalties. It's not like a CD where maybe you can get 5.5%, but they want to lock your money up for 7 months or something like that. So you have that, but so it's you're each time you move further up the yield curve, your volatility starts to get a little bit more. So if there's anything the further you move out in time, the further you move out on the risk curve, that increases your volatility, which would then increase your potential to lose money. So that to me right now, that's really the only downside. I mean, when we're talking about U.S. Treasuries and U.S. agencies and things, the United States is still considered the risk-free rate. So when you talk about a 3-month Treasury bill at 5.5%, we're the risk-free rate. We're in the world, we're still considered the standard, and and then you can move from there. So I'm not sure I answered your question, to be honest, but it's just with anything with investing, there's always some risk. It might be minute or it might be great, but
there's no trick drawback. It's like a hidden drawback. If you go money market right now, you're going to get a return that's pretty much right in front of you. It's going to be the 5%, 5.25, whatever, 5.5, 6, depending on where you go with it, at what level of limitation in terms of liquidity.
There's no limitation. Yeah, I mean, I can sell a Treasury bill in 5 seconds and have your money for you, relatively quickly.
And no penalties.
No penalty. The only possible penalty would be that, the price dropped. But, I'm buying short term. But the reason, if I'm laddering a bond portfolio for you, let's say I do 3, 6, 9, 12 months, I'm pretty much going to hang on to that 3-month Treasury bill, and I'm going to get that 5.5 annualized return from it because I know I bought it at $98 per bond, and 3 months from now it's going to be $100. So that'll be my 5% return.
Right.
So, no, not really. Again, it's just the risk and the volatility, and if something bad happens in your life and you have to sell a chunk of assets to take care of it, then you do have the potential for some loss. But if we're just laddering it out and everything continues to go smooth, it's pretty darn safe. And people always talk about I need to have my rainy day fund, and this is where certain financial planners and other gurus will get sideways with me. Look, if I have $50,000 sitting in the bank account earning nothing, or I can take that $50,000 and put it in something that's making 5%, 20 years, whatever the number is, my 20 years, $50,000 instead of being $50,200 could be $200,000, because how many people actually have to dip into their rainy day funds? So I don't, you can have it marked as a rainy day fund, but that doesn't mean it's not working for you. And that's my one thing I always say: you want your money always working for you.
Which is a good place. Time flies when you're having fun.
Yes, it does.
And we just ran out of time. We were having way too much fun.
That's right. Always do. Always do.
Well, Art, listen, I especially like that. Keep your money working for you.
Yeah.
The tip of the day.
100%.
Tip of the day. Rainy day fund. Keep it working for you as well.
Yeah.
So,
Yeah.
thank you for taking us through the 12th edition
Yeah.
of Taking Stock.
Yeah, I appreciate you. It's always a pleasure.
Pleasure having you, Art. Thank you very much.
Thank you.
Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.